far we've been going on this journey. Today, we're going to deal with this topic: accounting policy and accounting estimates. We're going to know the difference because I found out that most time differentiating it is a problem. So I have come with a simple solution in which we can use to differentiate these two things: accounting policy versus accounting estimate. So let's, without wasting much time, let's dive in. Now, differences between accounting policy and accounting estimate. Now, let's take a look at what accounting policy is all about. Can we put it in right now? Excuse me. Accounting policy are the specific principles, basis, convention, and rules and practice applied by an entity in preparing what and presenting financial statements. Now, literally, accounting policies are those rules, convention, policies, basis in which a firm, in which an entity applied when preparing financial statements. They are rules, they are regulations, they are conventions, they are laid down principle that you must follow to prepare your financial statement. You get that clearly? They are what? Lay down rules, lay down principles that have been put in place that you have to follow to prepare what? Financial statements. Now let's take a look at the purpose. Let's take a look at the purpose. They provide framework for consistent financial reporting and ensure comparability over time and across what entity. It is a framework. The purpose is for us to have a framework, a guide in which we can rely in preparing our financial statement. Like when you check an audited financial account, you find out that there is you see 212 here, for example, you see 211 here. Now you check the expense, the line item there, and the line item in 212 and the line item in 211 are the same thing. That is consistency. They have put it that way so that when preparing your financial statement, you have to follow that what pattern in preparing it. So that is accounting what policy. You have to maintain the laid down rules, the laid down principle to prepare what financial statement. They are the frameworks in which that guides you. Like if you want to prepare some, like in most audit firm, you want to prepare financial statement, you seek what for the template. Say, let me have the template of the firm. Every firm have their own what templates they use in preparing financial statement. As a new employee into that audit firm, all you need to ask is for, let me have your template, your what, your framework. Let me have it so that I can work on what? On the principle, on the convention, on the rule, on the framework that you have put in place. That is all about accounting what? Policy. Maintaining consistent convention and rules in preparing financial statements. And one of the purposes is what? Framework for consistent financial reporting. Now let's just take a look at some examples. Revenue recognition. The policy for recognizing revenue, e.g., at the point of sale or over the period of service. Now, recognizing what? Revenue. How do you recognize? When do you recognize revenue? Do you recognize revenue when you make a sale or what? Now, recognizing revenue entails the point at which you earn that amount. Recognizing revenue is one of the examples. The policy for recognizing revenue, e.g., at point of what? Sale. You recognize revenue at that point you made that sale. Are you getting me? It is a rule, it is a practice that you recognize it at the point of sale. Depreciation. The policy for calculating depreciation, e.g., straight line method or declining balance method, reducing balance method. Now, it is a rule, it is a convention, it is a practice that when computing for depreciation, you must use one of these methods. You don't come with your own method. It's either use a straight line method or a reducing balance method. It has been there, it is consistent that you must use it. That is the policy. They have put it there for you that whenever you want to calculate your depreciation, you use what? Straight line method, e.g., straight line method and reducing balance method. You don't come with a strange method to compute for depreciation. No, it is not the policy. The policy is that you must use one of the method of depreciation. That is policy. It's a laid down rule. It's a laid down convention. It's a laid down practice that you have to apply in preparing your financial statement. I don't know if you're getting me. Those rules that you have to apply in preparing your financial statement are what are called accounting policy. Let's go down. Let's check inventory valuation. When you want to, sorry, when you want to value your inventory, there is a laid down principle, rules, practice that have been put in place in which you will use to value your what? Your inventory. And they are FIFO, LIFO, weighted average. You don't import your own. They are those laid down what? Principles. These are policies set on ground in which an entity can use in preparing what? Financial statement. FIFO, LIFO, weighted average. They are laid down what? Principle. They are laid down what? Convention. They are laid down what? Policy. That is what? Accounting policy. Let's go down and see what is the nature. Policy are more static and less frequently changed unless there is a significant change in business operation or regulatory requirements. Now, this policy don't just change anyhow. This policy don't change anyhow. They are what? Consistent. That is their nature. They are what? Static. They are static in nature. They just, if there must change, there must be a regulatory requirement that is prompting it to change. There must be something significant that will make that thing to change. But if there is nothing significant, the nature is static. That is accounting policy. It is static in nature. It doesn't change. Very static. So whenever you want to differentiate, accounting policy deal with what the nature is static, is constant. It doesn't change frequently. That does not mean it doesn't change. It changes, but not what? Frequently. There must be what? A debate, a requirement, a regulatory that will make it to change. Are you getting me? Now, let's take a look at what? Accounting estimates. Accounting estimates are approximation of the amount of items in the absence of precise means of measurement. In the absence of precise means of measurement. They are adjustments made in carrying in carrying amount of an asset or liability. You didn't get this clearly. Sorry. Accounting estimates are approximation of the amount of item in the absence of precise means of what measurement. When there is no precise means of measuring a particular thing, it is called what? Accounting estimate. Now, revenue, there is a precise means of measuring it. That it is what? At the point of sales. That is why it's called policy, consistent. But here, there is no precise means. Approximation of the amount of item in the absence of precise means of measurement. They are what? Adjustments. Estimates are adjustments you make in your financial statement. They are those adjustments you carry out. They are not static. They are not laid down rules. But what? Adjustments. Now let us look at those adjustments. Now let's take a look at the purpose first. They are necessarily when item cannot be measured with precision and involve judgment based on the latest available information. When the purpose, they are necessary when item cannot be measured. That is the purpose. Now let's go further. Let's take an example. Bad debt provision. Estimating the amount of account receivable that may not be collected. You know what is bad debt? They told us those days in our secondary school day that bad debts are debts that cannot be recovered. That cannot what? Be recovered. But eventually, luckily, you recover some. Yes, at times you recover some luckily. Because you've written, you say, oh, these are bad debts. We cannot recover it. So if it comes, good and fine. If it doesn't come, good and fine. But eventually you see some, you appreciate it. Now, bad debt, provision for bad debt, estimating the with amount receivable that may not be collected. It's an adjustment. In your provision, you say, okay, let me just put that they are owing me 5 million. It's a provision. You made that provision. Are they really owing 5 million? Can you recover the 5 million? It's an adjustment you make. Bad debt. Can you collect the 5 million of the provision you made? It's what? An adjustment. Now, let's take a look at this one. The useful life of an asset. Estimating the useful life of an asset for depreciation purpose. Now, when you get a car, what is there a static useful life of a car? No. Some organization might get a car for 20 million and say that this car, the useful life is 2 years. So we say it's 4 years. So we say it's 5 years. So it's not what? It's not static. There is no law guiding it that when you buy a car, it must be 5 years. Or that when you buy a car, it must be 2 years. No. It's an adjustment. You adjust it to suit what you want to do. You estimate. I'm estimating this car to last for 2 years. No, 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 no. 4 years. No, 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 no. 6 years. That is estimate. Accounting estimate. It's not consistent. Why? Accounting policy is what? Consistent. It's a rule. It's a convention that you must adhere to. But estimate is not. Are you with me? Now let's check out the nature. I just hope you're getting this. Estimates are dynamic and subject to change as new information becomes available or as circumstances changes. They require ongoing adjustment. The nature of accounting policy is that what? It is consistent and less frequent change. That doesn't mean it does not change, but it is less frequent. Why the nature of accounting estimate is that it changes as new information becomes available. It changes with the trend. It changes. They are required for ongoing adjustment as they go, as the year progresses. They adjust. That is accounting estimate. Now, in a nutshell, accounting estimate is all about what? Adjustment, changes that might occur in liability or fixed assets. Let's put it that way. Let's go further. Let's take a look at the key difference. Nature and purpose. Nature and purpose. Now, accounting policies provide a consistent framework for preparing financial statement. This is just the key. Accounting policy do what? Provide a consistent framework for preparing what? Financial statement. Revenue is this, expenses is this, your fixed asset, you must follow this method. It's either you use reducing balance method or straight line method. Inventory, you use FIFO-LIFO weighted average. It is a framework and it is consistent that all whoever that is preparing it must follow it. Now, estimate involve judgment to approximate value where precise measurement is not possible. Judgment. You have an asset. You say, can this asset last for 5 years? Can it last for 4 years? No, 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 no. It cannot. Let us say it is 2 years. So that if at all, if we want to scrap it out, we can still make something out of it. So we say, let it last for 10 years. It involves judgment and changes. So these are the nature and purpose. So put this inside you. Now let's take a look at the stability. Let's take a look at the stability. Policy, more stable and less frequently changed. That is the stability. Accounting policy is stable and less frequent change, while estimate frequently updated and revised as new information becomes available. So once they ask you what is the difference, accounting policy is static and less frequent change, while estimate frequently updated and revised as new information what becomes available. You can have so many things to say about it now. You can say that accounting policy is a convention, rules and regulation that must be kept while preparing financial statement. Why estimate is not? It's based on judgment and adjustment in preparing financial statement. Am I speaking your mind? Let's continue. Let's continue. Impact of change. What impact of change do they have? Let's check accounting policy. Accounting policy changes are usually applied retrospectively and required reinstatement of prior year. Now, this is IAS 8, retrospective and prospective. Policy, retrospective is what? Prior year. You start the changes from prior year to current and continue. While estimate changes are applied prospectively from the current year ahead to the future. So in changes, policy goes back a little and continue. While estimate continues from the current year in which you are preparing that financial statement upward. That is the impact of change they have. Maybe I will do a video of more on retrospective and prospective so that you get more hint on that. But for the purpose of this lecture, of this video, we are dealing with just the difference between accounting what policy and accounting estimates. Now, let's go to summary. Let's go to summary now. Accounting policy are the principles and rules for financial reporting, providing consistency and comparability that you can compare one year and another. 2013, 2014, 2015, 2017, 2017, 2018. You can compare. Why estimate involve judgment and approximation in measuring certain financial statement items, requiring regular review and judgment. So both are essential for accurate and meaningful financial reporting. Both are very, very essential. But one, you have to follow the framework that has been set. While the other, you don't there's no framework, it's based on judgment and approximation and adjustment. You all apply. But the key thing is that both of them are essential for accurate and meaningful financial reporting. I hope we understand this. I hope we understand this. Thank you very much. We've come to the end of this short video, short topic. Though the topic is wider than this, but I just want to narrow it so that we will know the difference between accounting policy and accounting estimate. And with the explanation I have given, I believe that in a click of hand, once they say, what is the difference between accounting policy and accounting estimate? Pam, you have it at the tip of your finger. Thank you very much. I appreciate you all. Thank you for watching. See you in our next video.